The Business Journal Roundtable Series is sponsored by Advanced Technology Partners.
How should someone strike a balance between risk tolerance and financial goals? How should that change as someone ages?
I think changing as someone ages is a much more complicated concept than what's been talked about in the past. Everyone's in a different position. If they've got significant assets, it may not need to change as much. If they have a pension, it may not need to change as much. But finding the comfort level for an investor is one of the most difficult things we have to do. If we're too aggressive, they're not going to stay in a period like what we just saw a month ago. And if they're too conservative, they're going to leave too much on the table. So finding that level is really one of the most difficult things that we do, and then keeping the client in a period like a month ago. I'm sure everyone at this table was not enjoying themselves at that point, and trying to make people comfortable. That was a very significant policy shock. But the clients that were able to stay with it succeed, and that's our job. We've got to find that match.
I believe sometimes there's actually even a misconception about age and risk tolerance. Some of my, let's call them elderly clients, as the saying goes, they forgot more about investing than a lot of people even know today. They are shrewd investors. They understand market volatility. While we don't like it, no one likes those types of things, but some of my more experienced investors, they have usually the most conviction. Ultimately, I try to tell people also, truly understand your investments, what you own, but just as importantly, why you own those investments also. It can be very cliche to be a long-term investor, but you really have to understand that and fundamentally understand what your investments are. But like everyone I assume here would agree with, we do understand a lot more about volatility as we become more and more experienced as an investor. And as you go through episodes, most recently is another example, I think we just all become better long-term investors as a result. So I think it's an evolving process over time where you balance the risk versus the reward, but most importantly, I think goals-based financial planning is most important. Truly understand exactly what you're investing for, why you're investing, and what the underlying investments are to accomplish those goals.
I think too, diversification is important as well. So if you, Steve's point, if you work with a client and you tell them how they're invested and how diversified they are, so they don't have per se all their eggs in one basket, I think that's important for them to understand that they are not exposed too much to any one sector that might be volatile at that time. So I think that's important, just working with your client, having those conversations, reaching out to your client, being proactive when you have periods of volatility like we had about a month ago. So reaching out to your clients and making sure that you reassure them, that you are in it for the long term and you are diversified and this is what you're invested in. And, I think that bodes a lot to the client's confidence.
I think striking a balance between risk tolerance and goals is critically important before you even start to invest. So you should list out your goals, your objectives, your risk tolerance, your tax situation, and then you design the investment portfolio so that if you have a high risk tolerance as an individual and you're willing to ride the market up and down, that's okay, especially if it's longer term money that you're not going to be touching for 10, 20 years, like a 401k or IRA or Roth IRA, or money that you're just setting aside for your future. However, as you age and you start to pull money from those funds, you're no longer working, let's say, and you need to withdraw from those funds, it's a time to reassess again and determine, is now the right time to have that higher risk tolerance? Because if the market pulls back 10 or 20%, you have to pull money out. Are you liquidating in a down market, which oftentimes clients may not want to do? So it's something that needs to be reassessed all the time on an annual basis, I would say, at least, but especially on pivot points when you hit milestones such as retirement or if you're just starting to save.
The Business Journal Roundtable Series is sponsored by Advanced Technology Partners.